been horrific. So obviously the meltdown in June of last year was like it was completely heartbreaking. It cost me a lot of my credibility, I think. I've had a lot of people make very convincing threats against my life. It was a really, really terrible experience.
All right, welcome back, everyone. So we've got Mark and Nate from Bancor. Haven't been catching up with these two recently, and had a little bit of a brief demo, and thought it was very, very important to bring them both on and chat about what they're up to at the minute. So, gents, how are you doing?
Very well, thank you so much for having us.
Good on my end.
Good stuff. So yeah, I mean, before we get to it and everything, let's just show a brief kind of high level of both your roles at Bancor and kind of what you're kind of working on day to day, just to give people a bit of a flavor of kind of where you both are coming from. Maybe Mark, we can start with you.
Yeah, sure. So my name is Mark Richardson. I'm the current project lead at Bancor. In a previous life, I was an organic synthetic chemist. I switched to full-time blockchain research in 2021. I've been working for Bancor that entire period. And my main role, I suppose, is to define sort of the high-level scope of what the project is doing, and to provide the fundamental mathematics that underpins exactly how the products are working. So, at some level, I'm still a researcher. Obviously, I have a lot more responsibility now with like difficult decisions and other things affecting the direction of the project. But I still consider myself a scientist at the most basis level. It's just that the substrate that I'm working with now is, instead of small molecules, it's complex financial systems.
Nice. What about yourself, Ned?
Yeah, I've been with the project since late 2017, early 2018. I work mostly on sort of user education and helping the market understand exactly what we're building and how it works and how to use it, and driving user growth in the protocol and its products.
Nice. So if what I'm about to say might feel like people have been if they're not kind of crypto or DeFi native, can one of you give us a high level of what Bancor was, is, and is kind of going to be with Carbon? Maybe Nate, we can start with you and then move on to Mark. I know sometimes kind of the way people get across points coming from different kind of areas of the project can sometimes get delivered differently. So I'd love to kind of hear that from Nate, and then we'll move on to Mark.
Yeah, and its simplest way to describe it is we are very focused on-chain trading and liquidity. Bancor was first to market and the inventor of the automated market maker in 2017. Since then, we've seen tons of innovation in the AMM and on-chain liquidity space. A lot of catalysts more recently for driving traders and market makers and liquidity providers on chain, especially in sort of the post FTX world. So that's at a high level, is really ensuring that users can trade on chain as easily as possible, and also can have as much control and as much complexity and sophistication in their trading and liquidity strategies as they want. There's a lot of stuff that users tend to do in centralized exchanges that they have not been able to do until now on decentralized exchanges. And I think we're very much focused on, in order for DeFi and on-chain liquidity and DEXs to actually be true challengers to centralized exchanges, I think the functionality really needs to catch up. AMMs and on-chain order books need to continue to evolve, and so that's really what we're pushing forward with.
Nice. Mark, I don't know if there's anything you want to kind of add on that.
Yeah, I mean, just a slightly different perspective. So in terms of like where Bancor began and what the objectives of the project were in 2017, I think it is really worth acknowledging that the space has really come a very, very long way in a very short period of time. The specific problems that we faced in 2017 don't really have a lot in common with the problems that we're facing now. And in a way, I think AMM technology should be sunset. The original design that Bancor came up with the original bonding curves was that there is a need to facilitate like token to token price discovery, right? And be able to facilitate exchange. And the invention there, which is still largely, most of the AMMs that exist today still have a lot of the hallmarks of that early technology. And it's strange because the intended users, the actual liquidity providers that we were targeting with that technology wasn't end users, right? It wasn't individuals on blockchains, but it was whole token projects, right? Token founders and things. And it was customary at the time that if you are creating a new token contract, that a fairly significant proportion of those tokens might be dedicated forever to liquidity models. And it wasn't necessarily important, therefore, that the AMM be a financially performant vehicle because it wasn't for investment purposes. It was really a necessity, right, for cryptocurrencies to operate in a world where market makers refuse to touch them. That's no longer the case, right? Like even in the current like turbulence that we're seeing now, especially with the US, really centralized exchanges are still servicing most cryptocurrencies pretty well. There's always going to be a long tail component, and I think that AMMs will continue to service those tokens. But the people that are participating in DeFi have a very different motivation when they're thinking about liquidity, right? And liquidity contribution. It's much more selfishly motivated. And that's fine. And I think that this is the direction that not just our project, but all projects need to head in, is offering them something that is a little bit more expressive, a lot less prescriptive, and that gives people the flexibility to make choices in how their liquidity is used, and specifically what types of trading behavior they would like to participate in. And this is something that AMMs don't do very well from the maker side. So if you're providing liquidity to an AMM, the AMM really makes all of the decisions on your behalf, right? You are subscribing to a very specific trading profile. And most people feel like they are the victim of that trading profile rather than being an active agent or having made a decision to trade that way, which is neither here nor there. You could always make the argument that people understand how AMMs work and their consent is implicit in their decision to provide liquidity. But I don't think that argument holds much water, right? I think that people do feel like they have been told that they have a reasonable expectation of trading well in these systems. And the reality is that any of these mean reverting algorithms just doesn't perform very well. And so I think whatever we do next, we need to make sure that the people that are making orders, right, people that are providing that base liquidity, wherever that bid-ask spread is coming from, that it is aligned with their personal expectations when it comes to how markets develop, and not something that developers like myself or any smart contract engineer is prescribing for them to use. I think it has to be much more self-driven.
Yeah, it makes a lot of sense. So obviously I had a quick demo with Nate the other day on Carbon. I think it's probably best to, if we can start there and then get into the kind of differences, the trade-offs, the kind of pros and cons of what Carbon is versus a traditional, say, AMM versus a concentrated liquidity AMM, just to make it a little bit more tangible for anyone who's watching, anyone who's listening again on Spotify. If you can open the app and watch it in Spotify. I don't know what type of lunatic does that. You usually just go to YouTube. So it is on YouTube. We will get into a demo. So if you want to kind of see it in the flesh, just head over there and you'll be able to see it. So, Nate, have you got the demo available? I just want to kind of get into it because it's, as I say, I was kind of blown away by it the other day, and I think it'd be super interesting to bring up, and we can kind of talk through it.
Sure. Yeah, let me fire it up real quick. Let me know when you see my screen.
Yeah, got that.
Sure. Okay, great. So I think the easiest and most simplest way to describe Carbon is kind of like an automated swing trading machine. So if you look at this chart right here, let's say this is the ETH chart, and you think, over the course of the next couple months, and this sort of figure of numbers, that you think ETH might trade between 1,100 USD and 1,800 USD. Well, a user who thinks that information might want to sort of range trade or swing trade ETH instead of just sort of sitting on it, so that they're buying it low and selling it high. So in this chart, the user has set a range order for whenever ETH enters between 1,400 and 1,100 USD, they're buying it. And whenever it enters the range of 1,600 to 1,800, they're selling it. And doing this on repeat anytime the ETH enters the buy range and the sell range. And this has kind of been compared and might look familiar to grid trading, which is kind of a common and popular strategy in more centralized exchanges, and to date hasn't been possible in on-chain in DEX environments. So let's switch to the app real quick, and this is kind of the basic app, and let's try to replicate that strategy that we just discussed. Now, in Carbon, we refer to these as strategies. And let's say we want to do it with our ETH USD pair. You can do this with any ERC20 token. Let's start with ETH and USDC. And then here we can think about the different types of strategy types we might want to create. So there's two types. One are reoccurring, that consist of two orders. In this case, it could be limit orders. So let's say buy ETH specifically at 1,400 and sell it at 1,800, or range orders where you could buy it between 1,100 and 1,400 and sell it between, let's say, 1,600 and 1,800. Or you could do a limit and a range. And these will stay live for as long as you want to stay live until you pause the strategy or close it. Then there's disposable strategies, which are for one-time use. And this is just say, I want to, buy ETH specifically at 1,500 and have the order, automatically close for me once the liquidity is used. Or I can do that in a range with a buy range or a sell range. And these are just effectively similar to limit orders or range orders. And again, these are fully on-chain. They don't require any third-party oracle or keeper or any third-party infrastructure to withdraw the liquidity. When the order has run out, they're sort of self-executing. So let's create that range strategy that we discussed. ETH USDC, automated linked orders, and let's create that reoccurring strategy here. So it's going to fire up a chart of ETH USDC if my internet will kick in. But as that's loading, let's talk about, set those ranges that we wanted to set. So I think we said we wanted it to buy ETH between 1,100 and 1,400, and there's that range. Now ETH is trading significantly higher than that initial example, so I think it would probably make more sense, given ETH's current price. Let's say we want to buy it, possibly when it dips from 1,900 to 2,000. That feels better. And then I want to fund that with USDC. So let's say I want to put in 1,000 USDC. And then I want to set that sell range. And I think a reasonable sell range in this environment, let's say
10,000.
10,000 to let's say 11,000. And so those two ranges are set, and then I can decide whether if I want to fund this order. So in Carbon strategies, you can fund both orders, or you can only fund one order if you'd like. Now, in case I don't have too much ETH here, as you can see, I seem to have quite a bit of USDC. So I'm just going to fund the USDC side. This sort of starts to look a lot like single-sided provisioning. And as ETH enters my buy range, it'll use the USDC. The USDC will convert into ETH, and then as it enters the sell range, ETH will be converted back into USDC, and this will again continue for as long as I want the strategy to run, and it'll be buying low and selling high once I enter my ranges. So there you go. Created a strategy. Here's where all my strategies live. I can then use it. That's a former strategy. Let's go to the one that I just created. And I can manage the strategy. So I can decide, whether I want to close it, whether I want to edit prices. So this would be editing my ranges. And this is particularly interesting because if I want to edit these ranges, if you think about Carbon similar to, let's say, UniV3, where you might want to try to replicate some of these strategies, and we can discuss all the constraints and reasons that you can't do that currently in UniV3. But something that's particularly interesting is if I want to edit these ranges, well, in UniV3, you have to withdraw your liquidity and then re-add it to the range that you want to choose. Now, with Carbon, it's way more simple than that. You don't have to withdraw or re-add your liquidity. You simply have to update the parameters in your strategy's contract. And so here, let's say I'd rather go from 1,700 to 1,800, and let's keep the sell range the same. And so that's editing your strategy. You can withdraw funds, and then if you just want to stop trading, you can pause it. Now, you can sort of think of strategies somewhat similar to, let's say, liquidity provision or being an LP. So you're making liquidity and you're making it available for other traders to trade against it. So those trades can be submitted directly through Carbon's interface here, or they can happen through DEX aggregators, or it can be arbitragers that execute your orders once the market price comes into range.
We lost him.
Here here's the order book and the depth chart representing those. And then if I want to trade against those strategies, I can do so here. And let's just sort of enter a nominal amount. And what's very interesting is I can actually choose. Now here I'm only showing one strategy, but typically, there'll be more strategies that are in this range. But I can sort of choose exactly who I want to trade against. So let's say there's multiple orders represented in this routing table. I can just sort of select which orders I might want to trade against. And again, these will be traded against the strategies that are allowed in the book. These are the pairs that are shown that have live strategies currently. Hopefully, once this launches, there'll be many, many different types of pairs. And that is the real high level of how this works. Any specific questions or things to dive in?
Yeah. First, Henry, the audio is recording locally, so it should be fine. If we're hearing it as a robot there, it just uploads after, so it'll be fine. But you can cut this section out. So, a question on the range orders.
Yes.
Let's say we what did we use? We used 1,200 and 1,100. If I've got like a $1,000 range order set there, am I buying less at the 1,200 level than I am at the 1,100 level? Does it kind of ladder it down, or is it kind of linear how much I'm buying at each side of the curve or in between the curve? Like what's the dynamic there?
Yeah, so terrific question. Nate, do you mind if I take this one?
Sure, go ahead.
Yeah, so it's because we're still basing everything off of the the hyperbola, right? The familiar bonding curve that we're all used to. That beautiful. Sorry, someone just tried to call me. Okay. We're still using a very specific implementation of concentrated liquidity. So this is our own implementation, but it's still referring to the same geometry, right, that we're all used to. So if you take that that beautiful, hyperbolic curve that we're used to seeing from like Uniswap v2 and all of its, all of its various clones, what you do in order to create a concentrated liquidity plot is you essentially sort of stretch that curve out such that the curve now dips below and to the left of the origin. And that specific curve has certain geometric properties. One of those properties is that whenever you are moving between two different points, if you wanted to draw a line between those points, what you will find is that it has the gradient of descent is the geometric mean of the two gradients at either point. Now, I know that's super technical, but what it means is that you're always getting a type of logarithmic average, right? So the average that most people are used to is if I'm going to take the average of two numbers, I'll just add them together and divide it by 2, right? That's called the arithmetic mean. On a hyperbola, everything is logarithmic. And so in order to get the average there, you need to multiply them and take the square root. It's still an average, it's just a different kind of average. And so if you are getting, let's say that you would take a range between, I don't know, let's say, I'm trying to think of something that's got an easy square root. Let's say if you take something between like $2 and $8, for example, and that range completely fills up, the average price that you will get is exactly $4 because 2 times 8 is 16, the square root of 16 is 4. Whereas if you were doing a linear or arithmetic average, you would expect the halfway point between 2 and 8 to be somewhere around 6 or something like that. So in general, these two things, they get closer and closer together, right? The difference between the arithmetic and the geometric average get closer and closer together, the more tight your range becomes, right? So as long as you're not, spreading your liquidity out over orders of magnitude, generally the approximation that you're going to get the exact, arithmetic average or the familiar average is pretty close.
Nice. No, that's great. And we mentioned we can have the single-sided limit order and range in there. What's the kind of, is there anything in kind of behind the scenes testing that you guys have seen where there's like specific bespoke strategies that you guys are coming up with? Is there any kind of, are you setting a limit order right at the bottom of that range? Are you kind of, can you ladder it slightly above with less liquidity and then kind of ladder it down? Like how are you guys kind of looking at that just in kind of preliminary testing?
Yeah, I mean, I can show you. I've got my simulator loaded up right now, actually. If we can have a bit of a play around with it. So Grant, what's your what's your view? Are you an ETH maxi or a Bitcoin maxi? If you had to choose a cash asset, which one do you value against the other? You know what? I do like
to piss the bankless. I do like to piss the bankless guys off, but I am an ETH maxi at heart.
Great. All right. Well, then we'll choose ETH as our cash asset, which means Bitcoin is our risk. And let's just try and keep this pretty simple. Let's just simulate the last year. It's actually been a pretty good chart for analysis purposes. Not financial advice. Do the daily. Okay, so it's just going to grab that data from the API. It's going to quickly assemble a candlestick chart for us, and then we're going to be able to choose our liquidity bands on it. So generally on Uniswap v3, your ambition, right, is to keep your liquidity in range for like as long as possible, because as long as you're getting that trade volume, you're collecting fees for your position. So in your mind, like where do you think would be a good Uniswap V3 range to concentrate your liquidity on?
So can we go from, you see where it kind of, on the 27th of the 2nd, where that kind of high is there? So like on the second.
Yeah,
kind of
absolutely.
curve. And then we can probably take it to just the bottom of that candlestick to on the 15th of the 9th, maybe? Or if we're going to go wick to wick, whatever you prefer, candlestick or wick to wick, whatever's best.
Oh yeah. So did you want to go from the candlestick body? That's actually a really informed decision, by the way, because a lot of these wicks, like there's not a lot of volume there. So if you wanted to do the bodies, we could do something like that, or we could go slightly higher. You happy with that?
Yeah, sure. Let's go for it.
Okay, and then for Carbon, we can play around with these settings as well. So like, each one of these sliders will move we'll move those specific concentrated liquidity ranges. But here, the blue range represents where we're buying, and the orange range represents where we're selling. So which is very different to Uniswap, where you're buying and selling all the time, all the way through this. On Carbon, your buying and your selling are discrete quantities. So I'm going to keep the actual distribution the same. I actually think that's going to work out pretty well. So let's go ahead and use that. There are some other settings here for Carbon that's sort of, for advanced users. We can also choose our portfolio composition. Nice. If we're starting somewhere around here, like let's just do like 50-50. I think I think that's where Uniswap is likely to be starting at. Let's have a look. Actually, Uniswap's going to be starting, it looks like, completely in the risk asset. So we'll do the same thing on Carbon. There we go. Okay, and we'll choose 30 basis points.
Yep.
Okay, now the simulator will also, it's got an animation package associated with it, so you can get these very detailed, visualizations for how the simulation was run. I'm going to skip that right now, but I'll show you the animations in just a minute. But what we are going to do is save these summary plots. And so what it's currently doing is taking all of that price data, and it's literally simulating what the market is doing with each one of those positions. And so we get we get a log, and I'll show you that in a minute. But we also get these charts. And what these charts are showing you is how the liquidity changes with the price. So for example, on Carbon, you can see here we started 100% risk, which would be the same as our Uniswap V3. And so over here, nothing's really happening, right? As the price moved up, protocol isn't doing anything. But then as the price moved into this risk band, you can see now that this red color is kind of receding as the price moves through it, right? Which is exactly how most people expect an AMM to work. But what's different about Carbon is that rather than the liquidity, the cash liquidity appearing immediately behind it, it's appearing in this other range, right? The buy range that we had previously set. And so this means it's kind of holding onto its assets until the opportune times that you have nominated as a user. And then as the price dips back down, you can see that it's eating into some of our cash here, and some of the risk is coming back and so forth. And so as the price bounces around our strategy, we can monitor how our portfolio versus HODL position is improving. This yellow line is the HODL position, right? This is basically, it should be a mirror image of the Bitcoin price, because we started 100% in Bitcoin in this case. And the blue line, which is kind of deviating just slightly in some of these situations, that is our portfolio on Carbon in this particular case. So every time the blue line is above the yellow line, you're in profit, right? And every time the blue line is below the yellow line, you're in loss. And that's what we generally refer to as impermanent loss, right? This is the difference between your market making portfolio and the portfolio that you would have had you chose to do nothing at all. And so you can see at the end of this process, the difference between the yellow and the blue line is actually pretty good, right? And this is, remember, this is compared to just hodling Bitcoin this whole time. So we can have a look at the log to get an exact number, but just eyeballing it right now, it looks like the HODL value is somewhere around 1100, and the portfolio position on Carbon is closer to 1500. So this looks to be about a 50% improvement. We can have a look at Uniswap we can have a look at Uniswap v2. And you can see it's a very, very different protocol, right? The liquidity first is distributed infinitely far, right? There is no point where it runs out of liquidity, whereas on Carbon, it runs out of liquidity all the time. The yellow line, again, is the HODL, and the blue line is like immediately behind it. And you can kind of see here just how risk off a constant product protocol really is. So during this like massive rally on Bitcoin, the constant product portfolio barely noticed, right? But at the same time, at the end of this, you know, these lines are pretty close together. The profits that you're getting on constant product are pretty minimal. And then for Uniswap v3, it's similar to Uniswap v2 in the sense that the cash liquidity is always being refilled immediately behind the risk liquidity as the price moves around. But you can see already, right, that this blue line here looks to be, at least to my eyes, about 1250, maybe 1300. So about maybe a 20% increase. So let's check the log and get an exact number there. So this is our
that Uni v3 chart shows why people were so reliant on emissions for their rented liquidity. Jesus Christ.
Exactly. Okay, yeah. Okay, so Uniswap v3 at the end of that simulation, plus 16%. Not too bad, right? I mean, compared to hodling Bitcoin, plus 16% is pretty good. Uniswap v2 was plus 1%. Again, like no one's going to complain. If you're a Bitcoin hodler, you have ended up with 1% extra Bitcoin. But on Carbon, that was a plus 36%. And actually, I think this was, let me see, yeah, BTC ETH. I've got a couple of these simulations done, so we might have actually read from another one, but let me just check this one. Similar situation.
Just to clarify on the difference between the, like, if we're using Uni v3 as the example, as the closest kind of, I suppose the other that kind of outperformed, with the kind of upper and lower bound of the range, what would the kind of gap on Carbon be between your both range orders? Is there any way to kind of specifically determine the gap between the buy range and the sell range? How
absolutely.
Does one go about that?
So remember when we started the simulation. So let's just clear this and start a new one quickly so that we can play around with it a little bit more. Because remember, when we chose the Uniswap v3 range, we said we want to do like as fair a comparison for Carbon, so we're not going to move, you know, the ranges around too much, because it's very easy to be accused of biasing the simulation, which is something that I'm very conscious of, which is why I'm open sourcing this simulator for anyone who wants to use it. But once you've kind of got it, you immediately want to start playing with it, right? And changing, you know, how you might create a strategy and what you might do with it. So let's go back to that same pair, and rather than just leave the Uniswap range the same for Carbon, let's play around with it a little bit. So I think I flipped it around this time. It's now ETH per BTC, and I'm now, I think, doing a slightly different timescale. So let's do, like, for example, let's do like this one down here. I think that this would have been a really excellent Uniswap v3 position, actually.
Yeah.
Okay, now for Carbon, what we can do is move these sliders around, right? So just like what Nate was showing you when you're choosing your strategies on the front end, you can choose, for example, to like really separate, you know, really separate these ranges around. So one of the things that you might want to do is to set like a very, very low, very tightly concentrated buy. And then for your sell, maybe you want to do something that's a little bit more ambitious, right? Like maybe you don't know how far this thing is going to rebound, so you decide to sort of put your liquidity up like this or something like that. There's all kinds of different things that we can do. But the point that I'm trying to show you is that these bands, right, they are these bands here, right? It's the same thing. So if you wanted to set your, you know, your sell arbitrarily high, of course you can do that. You can also change like where it starts. So you can see here the liquidity that's kind of the loading bar, if you can think of it that way, of the liquidity level. Like here, it's only partially filled because some of the cash is kind of already being converted over here. You're on Carbon, you can actually start halfway through your range if you want to. So, for example, we can set our bid price slightly lower and kind of start in the middle of that range so that we kind of backload all of our liquidity so that we buy at the lowest possible price. And then if it happens to come back, we can kind of catch it as it's like retesting, for example.
Nice.
I would say that the kind of width of your range sort of reflects your confidence in a specific price. So if you think ETH is going to, for certain, hit 2,300, then you probably want to just do a limit order. So as tight a range as possible on 2,300. But if you're kind of unsure, you think it might be between, let's say, 2,100 and 2,300, then you would set a range, at those prices. And the sort of wider or larger the width reflects, less and less confidence around a specific price being hit.
Right.
Yeah, that makes a lot of sense.
So you can see here, right? This is that same, and I like this one because a lot of people sort of talk to me about what can you do during like a down only market, right? Or what do you do when things are going up, right? And these are the things that AMMs kind of typically struggle with. And so we could have simulated like doing something up here and letting the price move further down or whatever. But you can see here that the as the price came down into our cash range, we did see a small capitulation in our portfolio value. So this is our impermanent loss. That as the price started to move back, it held onto its assets long enough in order to start clearing a profit. And so here we're looking at the difference between 1,000 and 1,600 on Uniswap V2. Again, not too bad. Uniswap V2 actually seems to have done quite well here. And on Uniswap V3, right, you can see sort of where concentrated liquidity can sometimes struggle. So here, every time we go above this yellow line, that's our profits. And so the really disciplined liquidity providers on Uniswap V3, they know this really well. And so they know that during the drawdown, that's fine, because as long as it stays in range long enough, you can very, very easily clear back into profits. And so what they will be doing is like removing their liquidity every time it goes like back above this range. Whereas on Carbon, you're given a completely different financial vehicle, right? Where because you're already setting your ranges at certain levels, and you can adjust them as easily as Nate showed via the UI without having to withdraw and mint new NFTs and so on. You can manage these positions a little bit more efficiently. But yeah, you can see even in this case, and I would consider this one to be a particularly naive example. We didn't spend much time adjusting this. But yeah, the difference here, if we go to the log, for Uniswap V3, that made 1.9%. Uniswap V2 made negative 16%, and Carbon was plus 60%. So there really is like worlds of difference between how these things operate. Now there are some grain of salt here. The simulator is assuming things like perfectly efficient arbitrage, right? Like I need to afford the simulator the ability to sort of ignore things like liquidity levels. So on pairs like wrapped Bitcoin and Ethereum and versus the stables, these assumptions are generally very, very good. But if you're trading some like obscure meme token or something, the price data that you get from the API doesn't always agree with like the market appetite to take you at that price. So it's a laboratory conditions. You've got to take everything everything carefully and in a considered way. But what I do want to show you is what the animations look like. So here are some that I've prepared, earlier, and they take a little while to load. But this is just like a very quick 3-second. Actually, nice. You know what? I've got a better one. Let me pull this up. So this is, sort of an education resource that I'm creating. So because I want to teach people about, DeFi in general, not just about Carbon. And so these animations are intended to provide a very good heuristic for how these different protocols actually operate. And so the first animation, the one that you're looking at here, I'm actually visualizing Uniswap V2 as a literal order book, right? This is a depth chart. And you can see how much liquidity there is at a certain distance from the median price. And we're also looking at how the fee earnings are accumulating, right? So as the simulation progresses, you can actually keep track of exactly what the fee balance is for a Uniswap V2 position based on, you know, the assumptions made in the simulator. And you can see your portfolio sort of oscillate with the price. And, you know, this is no mistake, right? I've chosen an exponential sine curve here. And you can see that the period or the frequency on the performance versus hodl chart is exactly twice that of the price oscillation on the chart, because in constant product and all AMMs, it doesn't matter if the price goes up or down, you lose money, right? The whole idea is to for the price to go nowhere. I also animate it as the invariant curve. So if you're not used to looking at a depth chart, which people in traditional finance are very used to looking at depth charts, if you've been around DeFi for a little while, you're probably more used to bonding curves. And so the animation will give you the bonding curve as well. And it colors it based on the distribution of the liquidity. And so these are two totally legitimate ways of thinking about how liquidity is distributed on a DEX and how the market interacts with it. It also, of course, gives you the performance chart at the end. For Uniswap V3, we do the same thing. And, you know, one of the things to note about it is that occasionally the depth goes to zero, right? Because you're running out of cash or you're running out of risk. We also get the same invariant equation. So if you wanted to get a much better grip of exactly how Uniswap's invariant function works, this is it, you know, animated and graphed for you so that you can do that. And then, of course, last but not least, on Carbon, we also do the same animation, but trying to really highlight what makes Carbon different from these other two models. And the thing that I think really stands out is that as the price is moving through one of these regions, the price of the other asset, right, the thing that we're trying to sell, it doesn't come down to meet it. It's always contained within the range that the user has chosen. And of course, you know, this is for demonstrations purposes, so you can see that the performance versus hodl thing is always going to be very good here. But I'm just going to pause it here for a second because I didn't realize this the first time I was doing this research. But this particular strategy, so sort of buying sort of halfway down during the drawdown and sort of selling halfway up here, the portfolio versus hodl at this point, right there was here, which is basically break even versus hodl, which means that this strategy is the same as selling the exact top.
Shit.
Right?
So
which is an interesting realization.
Capturing the meat of the move there.
Exactly, right? Buying halfway on the way down and selling halfway on the way up, you actually get the same overall portfolio valuation as if you had sold the exact top versus hodl. And that is like, no one gets that, right? The exact top, or like the liquidity value there, like the actual volumes that get traded at the very top of a price chart, they're very, very thin. And I have a feeling that this is something that day traders have been like telling us on YouTube for like decades, you know, that it's not about calling the bottom and the top, but it's about having this strategy, this striated approach to markets so that you can get in and out of your positions in a really informed way. And it turns out that if you are disciplined in it, you can have your portfolio perform just as well as if you had timed the exact top. And here is, you know, just falling out of the Carbon simulation, a really elegant proof of that. And then, of course, we've also got the Carbon invariant. And now this is, you know, just for the DeFi nerds, right? For the people that are really going to get into exactly what the bonding curves look like on Carbon, because they are very different from how like they have the same shape as Uniswap's curves, but the way that they're parameterized is like worlds apart. And we spent a very long time, preparing our white paper and our invention disclosure to make this clear for anyone who's studying the space. But I still think seeing it animated is just one of the best ways that you can kind of get acquainted with it.
Is this available
and then
for
again,
people
yeah,
to is this available for people to get a hold of now, or are you going to do these seminars? Or
Yes. Yeah, absolutely. So I've, like I said, like I'm not protecting this code. I'm still in the process of kind of documenting it, but people who are interested, as community members reach out to me and ask me for it, I literally just send it to them and they can use it as it. So it works perfectly well as long as you've got an IDE. But like not everyone is, going to spend the time, setting up a Python environment on their machine in order to run it. And so one of the things that I'm tasking the research team with doing is to get it running just out of the browser. And so then anyone who wants to backtest a strategy can just do it directly that way. But for the people that are like maybe researching DEXs because they're starting their own DEX project, or maybe you're an analyst and you are evaluating the DEX space in general or something. For those guys, they certainly do have the programming expertise to make something like this work. And for them, I just email it to them and they can get started straight out of the gate with it.
Nice. There's a lot to. I said when we had
it's a lot to unpack. I know.
But I think it's just one of those. I think it's one of those things, and I've seen it with a couple of other projects quite recently. It's a lot to unpack, but so was like, I don't know, the first iteration of Bancor. Like as soon as you start using it, I think, and you start kind of trying it out and using it, I think a lot of DeFi is quite intangible until you actually get your hands dirty and go and figure it out. And there's like, we're kind of blessed with kind of low cost, high throughput, kind of quick, high transaction speeds and things like that now, where people can go and try this shit out without kind of having to spend an absolute fortune and stuff like that. So it's I can't personally wait to get my hands on it. So it's
I think that like one of the things I want to remind everyone, right, is that in a way, like we've gone to all of this effort so that you don't have to learn it if you don't want to, right? If you understand that most basic premise that I want to buy something at as cheap a price as possible and sell it as at as great a price as possible, that's it, right? You don't need to understand what these simulations are doing. You don't need to understand the bonding curves if you don't want to. But if you do want that, right, I want to personally empower you to understand it. I do think that people should understand what they're doing. But if you're just a trader and you understand that buying something cheap and selling it at a premium is how you make money in markets, then Carbon is developed with you in mind, right? You don't need to get into the weeds of this to use the product. The product is literally as easy as what we saw on the simulator, right? Choose your range, buy at this price, sell at this price, that's it. And it's only for the DeFi nerds that a lot of this extra material was produced.
Was there any kind of nuggets of kind of amazement that you found when you were building that, other than like I think the stats on HODL versus Carbon versus Uni versus V3, was there anything else that kind of caught you off guard or blown a hypothesis out of the water or anything like that?
There were so many things that caught me off guard. Like one of the things that that I've always been told is that like the HODL portfolio is generally the one to beat, right? This is the one that that wins most of the time. It's not really true. When you're having a look at like how day traders operate, they tend to not hold things for very long, right? They have a certain range trading strategy that they will set up either and run it over the course of a day, hence the name day trader, or over the course of a week or a month or something, and then they get out of it, and then they will like wash and recycle, right? And start one of these things back up on another pair that they think is going to be reliable. That was a revelation to me, because I guess I was kind of steeped in the culture of 2019 and 2020, when everyone was looking at these HODL returns with like a 10,000x increase in the Bitcoin price. But realistically, like I think everyone knows that those kinds of returns on HODL are not really sustainable. And so you have to kind of get clever in how you approach markets, and that there are certainly lots of profits to be had. But simply holding on to the thing is probably not the most informed strategy anymore. There are better ways, more informed ways of going about it. Of course, that means that there is an element of risk, but I would say that there's an element of risk to hodling at the same time. So there was that component, and then the other component was just how much better you can do, right? Like, I was expecting the first time I was running these kinds of things to be like, okay, if we can beat Uniswap by like 5%, I'll be happy. Like, I can market that. If I can beat it by 4% or something, I'll be happy. But we're like consistently beating it by like 50%, 30%. You know what I mean? Like, even really naive, strategies were outperforming the status quo by a fairly wide margin. And the reason is like, it's actually perfectly clear. It's just that rather than having to buy and sell throughout that whole range, concentrating the opportunities to one side or the other asymmetrically is, it really is just a better way to trade a market. And I think that the AMM naysayers have been telling us this for like years. And I think it took me a little while to, I always understood what they meant, right? And I had the numbers and I had the analysis and I got it. But like now it's like in my bones, right? Having built Carbon and really run this thing, it's like now it's a part of me. I really understand it now in a very visceral way.
You see in these simulations when you close your eyes at night.
Yeah, it's true, actually.
I think the mind-blowing part for me about this and the sort of aha moment was just how much this kind of changes the incentive model and mechanics of traditional LPing. If you think of, what are you trying to do when you LP in an AMM? Well, you want to collect fees, and you're hoping that the two assets do not diverge in value too much, in which case your impermanent loss would exceed your fees. Now, in Carbon, fees and impermanent loss are actually completely irrelevant. The LPs, or let's say, we're calling them makers, the creators of these strategies, are just interested in executing trades in specific, price ranges. And so, fees are completely irrelevant and IL is completely irrelevant. They're just wanting to buy low in this range and sell high in the upper range. So as a result, the tokenomics implications of that are pretty interesting too, where suddenly, 100% of the trading fees can now go to the protocol. None of them go to the LPs. Similar to if you're setting a limit order in, let's say, Coinbase, you're not expecting to collect trading fees. You're just expecting for the trade to execute at a specific price. So that was pretty mind-blowing for me, is how this really could change the entire incentive model for LPing. Also, Mark, you described this before, but how the traditional form of LPing and Carbon are not necessarily at odds. They can be very, very complementary. There's sort of an interesting strategy, Mark, you've mentioned a couple of times, about sort of flanking your, let's say, UB3 position with Carbon orders. Do you want to just kind of walk through that?
So like a hybrid kind of model?
Not really a hybrid, but if you think of it this way, on Uniswap v3, like Uniswap v3 can be exceptionally performant, right? I have run many simulations where Uniswap v3 is the one that wins out because the volatility just isn't there for the buy low sell high to be as attractive, especially on things like stable pairs, right? I think Uniswap v3 is exceptionally good for something like DAI USDC and so forth. But what you might be worried about on Uniswap v3, let's go with USDC and DAI. Something like a DPEG event, right, which happened not that long ago. And as soon as the USDC price started to capitulate down, your valuation goes like completely, down the drain, because now all of your DAI is gone, and you're left, holding exclusively USDC, and now it's only worth, 80 cents or something. I can't remember how far it went down. I think it was 80, 85 or 88 cents. And that's terrible. But on Carbon, let's say that you did have that, you did have that position on Uniswap. You could then kind of hedge your Uniswap gambit by saying, you know what, if it does go to, all the way down from $1 to 88 cents, I'm going to buy a whole bunch of USDC at that exact price. Like if the market is looking for liquidity as it's depegging, sure, they can have it, but I'm not going to give them like the price all the way from $1 to 88 cents. I will give them from like 90 cents to 88 cents. Like if you're really depegging, I'm taking the risk. And so that's the price I'm offering. Yeah. And so if you've got your USDC or your USDC DAI strategy on Uniswap, you can actually then go to Carbon and create like these depeg, hedges on either side of it, that would, exclusively buy that thing as it starts to move to the other side. Now, maybe the stablecoin analogy isn't the best, but certainly for things like ETH wrap Bitcoin or ETH USDC, where you might get those occasional wicks out of your range where you're not earning fees. On Carbon, you don't care because you're not there for the fees, you're there for the execution. And so if it wicks up out of your range and then comes back into range, at least then you've got like, you've managed to process that very profitable trade because the price went up and then back, but you got to keep the profit now. Whereas when the price goes up and back in Uniswap v3, it's like, yeah, you're getting fees again, but you've lost all of that value that you had from processing the trade at that other point. So I think some of the frustrations that I've heard vocalized were articulated exactly that way, right? They're sick of being toxic flow on good days, and then effectively the market refunder when things capitulate.
That's a great way to put it.
And on Carbon, yeah, right. And on Carbon, all sales are final. If someone took you at a certain price, that's it. They have to, if they want to sell it back to you, they have to sell it back to you at the other rate that you've chosen. And so if you do want to sort of profit from the moves out of your concentrated liquidity range on Uniswap v3, you can literally flank it by having a similar, an equal and opposite strategy running on Carbon at the same time. That's like maybe a little bit more concentrated and doesn't need as much capital in it. And so that way, like if things are moving out of your Uniswap range, you actually are still making profits on this other protocol. And so I don't see them as being competing resources, right? Uniswap v3 and Uniswap v2 and most AMMs, they are a short gamma strategy, right? Your bet is, I hope the price doesn't move very far. And I hope that I get a lot of trading volume. That's it. Carbon is not that. Right? It is, I hope the price goes down to this level and then up to this level. Or I hope that the price goes up to this level and then down to this level. It doesn't really matter, but it's a completely different bet, right? The financial instrument that they represent are different. And you can use them together to create a much more balanced approach to the markets. So if the markets really are just kind of jittering sideways, Uniswap's your man, right? It's the best possible protocol for that kind of fuzzy, go nowhere price action, especially if it's got a lot of volume. Whereas with Carbon, that violent, moves to one side or having a directional position in how the markets are moving, that's much better suited to that type of trading strategy. And there's nothing that says that you need to be in one of these camps at once, right? You can be in both of these camps all the time and have a strategy on Uniswap v3 that is doing the short gamma thing, but at the same time be like, well, but maybe it's not going to do that, forever, and I want to have a position on Carbon that kind of takes advantage of it when my position on Uniswap is starting to fail. So taking a balanced approach to making markets on DeFi, I think is a very intelligent and well-informed thing to do.
Well, I'm even thinking further afield. Like there's so many projects that we've spoke to recently that are coming onto the fore. It seems like a lot of projects are trying to lead with a stablecoin now. and a lot of them are getting priced out, particularly trying to play the curve game. Like it's just completely priced out. A lot of emissions spent on trying to bribe curve and CVX photos and Frax photos and things like that. So things like this where it allows them to actually bootstrap their own stablecoin aside from the perg, either above or below. I think it's they need to be kind of looking at that. I know the Tapioca guys, they just said, look, we can't afford to just be wasting emissions left, right, and center with Curve. We're going to go with Uniswap through Arrakis and things like that. But it just seems like a great kind of additional option to have, as you say, as a kind of a complement to that if they're looking for like these kind of pegs.
Yeah, I'd like to discuss it with them.
Yeah,
I'd
absolutely.
like to discuss it with them, honestly. I've had a couple of not necessarily stablecoin projects. Like I haven't met anyone yet that like wants to do like a USD pegged asset, but I've had like 2 or 3 other conversations with people that have like gold pegged or ETH pegged assets, and that they want like they realize immediately that because of the asymmetry on Carbon, you can kind of create more of a price magnet right back to some range because it doesn't constantly slip. One of the things that Carbon does, for example, that no other concentrated liquidity protocol except MStable does, is infinite concentration. So if you wanted to, we can concentrate the curve down to just a straight line and execute all of the liquidity at a single price. Whereas I think on Uniswap v3, you're limited to 1 basis point, which is still like pretty much a straight line, but it's still not exactly a straight line. And when you're talking about pegging assets, sometimes the difference between 1 basis point and 0 is important. Maybe not right now, but certainly in the coming years, I expect it to be. So yeah, there is that use case, and I would be very interested to discuss it with them.
Yeah, I'll put you in touch after this. What about, how does it look like for automation? If people are gonna, is it something that can be achieved? Like I'm just thinking, if someone's want to come in, they don't have to want to manually position their ranges. Like, is there any kind of thoughts around that? Is there additional people building around that? Is there anyone on the market that could build around that?
Of course, yeah. Like so, I'm a big fan of Arrakis already, and I've met them in ETH Denver, and we've had conversations with them on Twitter Spaces and things previously. I do expect that there will be these kinds of third-party integrations where there will be something like a vault manager, right? Similar to Enzyme or something like that, similar to the yield aggregators on top of Uniswap v3 that will use Carbon for its intrinsic use case, but kind of crowdsource the capital that goes into those positions. And there's nothing wrong with that, right? I would be, I'm always interested to talk with those integrators, and they will do things like charge a performance fee to their users and so on, and that's fine. But I don't think it's something that I want to, like, I would rather provide the rails. Like I'm much more of like, provide the infrastructure. And if people want to build products on top of it, of course I'm going to support them. But I don't necessarily think that needs to fall under our purview. I consider those kinds of, those types of products to be like specialist products, like to build the infrastructure and then build that kind of product on top of it at the same time. That's a lot to manage. I would rather just keep the engine running and support the other teams that want to use it for that end.
All right, awesome. So when can we have a go? when can everyone listen and try it out?
Very, very soon. So we put the proposals on governance a couple of days ago. I think we should be finished in like 24 hours, and we're ready to go. As soon as we've got the DAO approvals, we will, we'll get all of our ducks in a row and hit the enter key and load it up. Yeah, like it really is right here. Where I wouldn't have put the proposals up if I didn't think that we weren't ready to deliver after the DAO made a decision. So days at this point, days away.
All right, perfect. So I think I'd be a bad interviewer not to ask, how has the past 12 months been internally with you guys at Bancor, and what's the kind of, how does Carbon play into like the next evolution of Bancor and things like that?
Yeah. I mean, it's been horrific. So obviously the meltdown in June of last year was like It was completely heartbreaking. It cost me a lot of my credibility, I think. I've had a lot of people make very convincing threats against my life. It was a really, really terrible experience. And I think that everyone that I work with had a fairly similar experience, right? Everyone, especially in a public facing role. And we've been sort of tormented ever since. And a part of me feels like I can't complain. I did have I was a part of the process that kind of led to that thing, and so I kind of wear my punishment. But yeah, it was pretty awful, and my only driving motivation with Carbon is to create something that actually can tenably start addressing what I consider to be the protocol's obligations back to the users of version 2.1 and version 3. So the problem still stands at that when the meltdown happened, for those who are listening and aren't aware of the specifics of it, it turns out that something like 60% or more of the liquidity provision in Bancor version 2 and Bancor version 3 was owned by 3 Arrows Capital and Celsius. And so when they withdrew all of their liquidity all at once, they had also been liquidity mining the whole time. So they had a massive share of the BNT supply. When they were in a tight spot, they obviously had to liquidate their position. So they withdrew. The impermanent loss protection was completely stressed by it, and at the same time, they were also dumping their BNT position. So the whole mechanism was completely destroyed, and that threw a lot of the balances on V2.1 and V3 into deficit. Now we have actually we've already recovered from a lot of that damage. So beginning last month, a lot of the Chainlink liquidity providers, especially in version 2.1, have been withdrawing all of their liquidity plus fees that have been earned in the interim. So we really are starting to recover in a very positive way, and I'm really thankful for that. There's still a long way to go, but the question that we have been trying to answer since that day is, how do you create a protocol that is actually generates value? The problem, I think, with the culture surrounding DeFi summer and the bull market that it led to was that people thought that these token printing schemes and liquidity incentives were just free or something, right? That you just kind of got that value for nothing. And it sounds like you had a conversation just recently with someone who is talking about the kind of frustrations that they have with curb emissions and that kind of thing. And so it did affect us in a pretty big way. And I was, I do want to say that I had vocalized my concerns about, liquidity mining campaigns and things previously, but at the end of the day, whatever the DAO wants to do, I have to oblige. And, at the time, I can tell you it was a very unpopular opinion that liquidity mining had to end. No one wants to listen to that. So Carbon is designed to be a protocol that you don't have to pay anyone to use, right? It should be its own incentive. There are things that you might want to do in the markets, and you can't do it anywhere except Carbon right now. And for that, we charge a pretty nominal fee, right? 20 basis points on trades, and I think $1 worth of ETH on making positions. So really nothing. And the hope, my ambition is to make this sufficiently popular that we can use those funds to recover the deficits on version 2.1 and version 3 very quickly. And that is what the DAO has agreed to, right? There has been a vote already that 100% of the revenue from Carbon should be used exclusively for that purpose, and that's what's going to happen.
Nice. Well, gents, that was great. As I was saying before we kind of jumped on, I think it's going to be a big kind of paradigm shift in the DeFi space. I think it's going to be a lot more user-friendly for those who want to be makers on the platform. those who want to kind of have a set and forget strategy around the desired kind of bids and asks. I personally can't wait to get my hands on it. And we're recording this on, what's it, the 18th. So maybe by the time it's gone live and you guys will listen to it, you might be able to give it a whirl. But is there anything else you want to kind of finish off though before we kind of wrap it up? Is anywhere you want kind of people to be funneled to, maybe Discord or whatever, and what should they be on the lookout for?
Nate, do you want to take that?
Sure. There's
All right,
Carbon,
Nate, go ahead.
yeah, carbondefi.xyz is where you can find all our social channels. I would say the Carbon specific Telegram and our Discord are kind of the most active for that. We've just released the open source contracts with a $1 billion bug bounty. So, feel free to check out the contracts. The docs are up as well. Once the DAO finalizes its vote, we expect the beta mainnet release to go live in the coming days, and I think it'll be super exciting to see what happens. We have seen a lot of interest from both retail all the way up to the most sophisticated institutions saying that this is finally what they need to actually execute limit range orders and the type of strategies they've done in centralized exchanges on DEXs. And then on the other end, on the retail side, we've seen people wanting to buy low, sell high, set limit orders, range orders, and not being able to do that because of current on-chain liquidity mechanics. So super excited to see the range of uses, the type of user it draws. And I think it'll be a wild ride in the early days of this.
Awesome. Can't wait. But gents, thanks very much. I know you must be getting close to crunch time now if this proposal goes through, which I'm sure it will. So thank you very much for joining me. Welcome back anytime. Just say the word. And
thank you so much, Brett.
And if you want, once you've kind of published and got everything live, and we want to run it back to some demos, see what's happening, if this protocol is building on and around, get that done as well. So just, as I say, just let us know. Always happy to help. And for everyone else listening, if you listen on Spotify, if you want to see the demo, just go and have a look on YouTube. But yeah, thanks again, and speak to you soon.